Hey, this is Tom Gerard again, and I'm here in my home office for the starting up this summer accounting course. And in this chapter, we're going to be talking about current liabilities. So remember, we're talking about time frame now. So when we're talking about in accounting, in the world of accounting, we live in a time frame. So it's a year, it's a quarter, it's a month. It could be 5 years, like we talked in the last chapter about depreciation and how long we're going to depreciate different long-term assets. Well, remember long-term assets and current assets. So in this chapter, we're going to talk about current liabilities. So remember, a liability is something that we owe somebody, right? And current means during this year. So think about if you buy a house and you have a mortgage. You might buy a house for $250,000 and you're paying for it over a 30-year period. But your payments are going to be over a 30-year period. But what are your payments going to be for the next 12 months, for this year or this time frame? And that's what we're talking about when we talked about current liabilities, is within this time frame, what do I owe people, right? And how am I going to have enough cash flow to pay for it? So let's go here. So one of the things what do we normally pay for when we think about current liabilities? Well, the main thing is accounts payable. These are things where we've received goods or services from what we call our vendors or suppliers or people that perform a service or give us goods or services, and we owe them. See, so think about, remember, we've talked a lot about this in accrual accounting, where somebody's providing a service and maybe they're coming in every day. Maybe my son is in a professional exterminating and sanitation. And during COVID, every single night they would go to the Amazon distribution centers and sanitize it all during the count, and they went every single week. Now, obviously, and there's Amazon places all over the world probably, but at least in the United States, that we're all getting this service. So the company is not going down there and the person's paying every single night. Well, they're paying this over here in Broken Arrow, Oklahoma, and now they're paying for it over here in Little Rock, Arkansas. And no, what happens is the company provides a service and they send the bill the next month for this month, right? So if this month is June, then they're going to get a bill in July for all of the June services for all of the buildings throughout the United States, right? So that means when we get the bill, now on the business side, we're paying for it. We're Amazon in this case, for example. We're going to pay for the sanitation services, and we're paying in July for all the services we got in June. So this is a liability, right? Because was the service provided? The service was provided in June. And in June, Amazon owes for June, even though June hasn't got over yet. Or maybe now June is over, it's July, and they have to pay it. So accounts payable is one of the typical things that we think about when we're talking about current liabilities that has to be dealt with. And many times, again, like I said, if you go to work as an entry-level person in bookkeeping or accounting or an office environment, you start working in accounts payable because, what are we going to do? Every business has to pay bills. We got to pay our electric bill, our rent, our suppliers. And what's the biggest one? I've said it before. I know inventory, right? We had the whole chapter on inventory. What's our biggest expenditure for most businesses? Payroll. And so we tackle payroll in this chapter. And why is payroll considered a current liability? Well, because think about yourself. If you work in June, then you expect to be paid at the end of June, at least, or hopefully, for June's work, right? You don't want to say, oh, well, you can pay me next year. You can pay me in January for this June's work and for July's work in August. Well, if you can do that, then maybe you're, independently wealthy or something. I don't know. But in general, we're thinking it's a short-term or a current liability because the company owes you for your work that you provided, right? Now, it's a liability because many times you don't get paid until after the time. So think about, I've worked this week and I'm going to work next week and I'll get my paycheck at the end of 2 weeks. However, if we get paid every 2 weeks, say, and I decide I'm going to leave the job or I've got fired or whatever, then after the first week, then it's still a liability for the company that they have to pay me, right? They have to pay me for this time that I provided my labor, so to speak, during this time period, but they're going to pay me in another time period. And when I'm talking about time periods now, it makes it really real, and why this keeping track of all this is so important is because it's really not so much like we've been talking month to month, but what we're really talking about is year to year, right? Because what happens, we want our financial records, which is for a quarter or for a year, to be absolutely accurate. And if I'm in December, and let's just say we're on a calendar year, that's another story on, fiscal year, but let's just say I'm on a calendar year and I've worked on December 31st, then when am I going to get paid? Well, maybe I don't get paid till January 5th, right? Or whenever my next pay period ends. So when they start the year of January 1, my employer, it's a liability for the previous year, right? I owe my employees who worked in December of the previous year. So that's when it gets to be very important that we make sure that we're recording to the company. Remember, we're the matching principle. We got to match when did they provide the service and when are we going to record the expense on our books for that service. And in this case, we would have the salary or payroll expense, and then we would have the liability for that specific, the part of the expense that was for December. So maybe that payment is, you get paid every 2 weeks. And so maybe you had a week in December and a week in January that crosses fiscal years. So you'd have the expense and the cash for January, because you're paying in January, but you'd have the expense and the liability for the December, right? Okay, at the end of December. So payroll is a complicated thing. And again, you may start off in accounts payable. You may start off in accounts receivable. You may start off in payroll. Now, accountants keep track of payroll. And one of the things I will say about the payroll, and think about this, and again, I teach this as though you've never been exposed to this accounting world at all. But think about it. Oh, I got a job and I took this new job because I'm going to give it $20 an hour. And at my last job, I was only making $15 an hour. And I've got a really great raise because I'm going to go get this new job. And so now I've got the $20 an hour job. But then what happens? I work my time, my hours, and then wait a minute, my paycheck, I'm good enough at math to see that my paycheck doesn't match what the $20 an hour. Right? Well, that's your gross pay, $20 an hour. But what do we do when we live in the United States and probably most countries in the world? Taxes. So when we're talking about payroll, one of the things that you'll get into here is a lot about taxes. And there's a lot of taxes. We pay taxes out of our payroll. Your employer pays taxes out of your payroll. And then there's also insurance for unemployment insurance and different things. And anything that has to do with the government or the government regulations, there's complicated formulas to come up with this. So we think about payroll, all of these things is right, has to be very specific because and correct. And again, think about yourself. If I've worked my 40 hours a week or whatever it is, and I'm supposed to make $20 an hour, but they're taking all this stuff out of my check, I still want to make sure I'm getting what I'm supposed to be getting, right? Well, and the employer wants to make sure that they're paying you what they're supposed to pay you, that they're withholding the right amount of taxes from you that they owe to the government. Because if I withhold taxes from your check, then I owe that taxes to the government. And payroll taxes is divided up among different taxes that you'll get into in this chapter, and I don't want to do it in this introductory video, but we'll see that. Okay, so let's see what's next here. What about fringe benefits? So fringe benefits are those things that I'm not necessarily legally required to withhold from your check. But we got vacation pay. So vacation, in fact, that's really not the best one to start off with. Other fringe benefits might be your health insurance, or maybe you have a life insurance policy at your employer. Somebody's paying that. Either you're paying it or they're paying it, or both. Maybe you have a 401k. It says pensions. We talk a little bit about pensions in this chapter. And again, all these things are very complex, and there's people that specialize in each of these little categories, especially when we talk about fringe benefits and IRAs and 401ks and those kinds of things. And sometimes you have where you're paying a part of it, and then your employer matches it. So there's a lot of accounting involved in making sure that's all correct. Now, that's a fringe benefit. Now, what about vacation? The thing about vacation is this. You're getting paid because you're supposed to be here working, right? But when you're not here working, think about, and I know everybody's got different kinds of jobs, but just think about if you're even fast food, or you're providing a service. If it's a fast food place and I've got to have somebody at the cash register, or maybe you're a factory and I need 10 people to work on this factory line. When you're not here, I have to have somebody to cover for you. In other words, I can't just, he's on vacation, so we'll shut down for the week, right? So think about that. That means that I'm paying you for not being here because you're on vacation. Now you're enjoying yourself. Hopefully you enjoy yourself on your vacation. But I'm also having to pay somebody else now. Maybe I'm paying somebody overtime, or I'm having a temporary employee come in to cover for you, or whatever it is. But I'm in essence, I'm paying this salary twice, because I got to pay somebody to cover for you, and I got to cover you because you're gone, right? And so that's there's accounting involved in that, right? Because now I'm paying you for work that I'm not getting anything out of you. Right? And so remember, when we're always talking about this matching principle, and I talk about it a lot because it's about when you get to managerial accounting, is management has to determine, well, if you're on vacation, do we just leave that spot open? These are managerial accounting type things, thought processes, but this is why this is important now in financial accounting, because as a manager or a managerial accountant even, I need to have accurate information on the financials to make decisions, right? I want to make decisions about the future. So maybe we look at where you're looking at next year's budget and we're saying, well, we let all those people go on vacation in the middle of June, and then all of a sudden June was a really good month when maybe normally it's not, and I had to bring in some extra people, or I had to pay people overtime, and how much did it cost me to cover for you on vacation? So all these things are important. And if I don't have that information that's accurate and correct, I'm not going to be able to make decisions. Okay, fringe benefits. And that's about all I want to talk about in this chapter. Payroll, very important. I tell small business, and I'm very small business people orientated. I know we teach the course as though we're talking about corporate accounting, corporate finance. But if you're a small business and you have only a few employees, maybe you can handle payroll yourself. I am you are not an expert in accounting because you took this class. This is an introduction to accounting, financial accounting class. You're not an expert. Now, anytime you're involved with the government and taxes are involved, or maybe people's pay even, hire a professional. Hire somebody that does payroll, okay? There's companies out there that's all they do. They are professional payroll companies. They're going to make sure your taxes withholding is right. They're going to make sure that the government gets paid on time and correctly, and they're going to handle it if anything goes wrong. When somebody quits or somebody gets fired, payroll companies specialize in this. And so I always say, if it has to do with the government, taxes basically, always hire a professional. Do not try, it's not expensive, right? Payroll is not an expensive thing to pay for, to be honest with you, in the world of accounting. It's relatively inexpensive. Now, if you're a big corporation, you got a whole building full of people that do this. But I'm talking about a small business. If you're running your own small business, pay somebody to do your payroll for you. You don't want to mess with the government. You don't want them in your business. So that's all I got to say about that.